Now, if you are committed to building real wealth, you've likely heard the advice to either do it yourself your investments or hand over your money to an asset manager. But which part is truly better? In this video, we are analyzing the real-world portfolio of a Dutch client who placed his trust in an asset manager 3 years ago. So let's see if it's paying off or if there's a smarter way to grow your money. We will focus on three key points here. Number one, why this client's portfolio is underperforming and why most active managers face the same challenge, and why you should be aware of this. Number two, the impact on fees on your portfolio and how much this client has been paying annually, and you won't believe this. Number three, how your yearly performance can dramatically affect your overall returns over the next 10, 20, and 30 years. Now, let's dive in, because if you have been following my channel for a while, you know I've spent over 15 years in the financial industry helping clients grow their wealth in smarter, faster ways. And this client approached me because he was unsure how well his portfolio was performing, as he lacked the knowledge to look at it at a deeper level. Now, to clarify, his asset manager from a well-known bank in the Netherlands invests solely in one fund, the ENG Select Fund Neutral. And over the past 3 years, this fund achieved a return of 8.6%, which translates to an average annual return of about 2.87%. So the first question comes to mind is, how does this performance stack up against its benchmark? Now let's compare this to the performance of the benchmark indices the bank took. And that is first of all the MSCI World Developed Markets Index. And the second one is the FTSE EMU Government Bond Index. For MSCI stocks benchmark, the performances are in 2021 22.35%, in 2022 minus 17.7%, in 2023 24.42%. So the average annual return for the MSCI stocks benchmark over these 3 years is approximately 7.3%. And for the bonds benchmark, the performances are in 2021 minus 3.5%, in 2022 minus 18.5%, and in 2023 7.16%. So the average annual return for bonds over these 3 years is approximately minus 3%. Taking the 50-50 approach, 50% stocks, 50% bonds, we take 50% of minus 3% and 50% of 7.3%, which gives a return of about 2.15%, right? So yes, the fund did a 2.87% and did outperform its benchmark by 0.72% in 3 years. But there's more to the story. Let me explain. Because this is an active management portfolio, which means that a fund manager actively makes decisions about which investments to buy and which investment to sell, trying to outperform the market. The goal is to beat the market by making strategic choices based on research, market trends, and predictions. The problem here is that the most of active managed funds are not outperforming their benchmarks over the long run. The appeal of active investing is that a financial expert with deep market knowledge could in theory outperform the market by picking undervalued stocks or predicting downturns. And the hope is that they can avoid major losses in your portfolio by stepping out of the market before a massive crash will hit the stock market. But here's the challenge. Can anyone really do this consistently? As Jack Bogle, the founder of Vanguard and creator of the first index fund, emphasized, most investors, including professionals, find it very incredible difficult to consistently beat the market over the long term.
Picking stocks or funds, finding that elusive needle that will give you what you think you want in the future is very difficult. We all know the metaphor of finding a needle in a haystack. It means forget it, it's not worth trying. And I would argue the same thing here.
So let's take a look to the important data studies have shown. Here you see the stats from active managers who are able to outperform the S&P 500. What is interesting to see is that in the first year, in yellow, there are around 50% of the managers that beat the market. But if we stretch this out over 20 years, it becomes clear that on average, actively managed funds often underperform broad market indices like the S&P 500, especially when fees are factored in. On average, after 20 years, less than 10% is able to outperform the market. So more than 90% of actively managed funds are underperforming over 20 years. So the key risk here with active investing isn't just that you might fail to outperform the market, but that you could also miss out on significant gains while attempting to time the market. So back to the portfolio. Do you remember that the ING fund outperformed its benchmark by 0.72% over the 3-year period? Well, yes and no. While it's true that the fund did better in terms of returns, we need to consider additional factors. The performance of returns already covers the ongoing cost of the fund, but what I haven't mentioned yet are the cost of their services. So let's delve into the second point, which is crucial when investing in the stock market, and that is costs. In everyday life, paying more often means better services or better products, right? Like in good restaurants, for example, or buying luxury cars, where higher prices generally means higher quality. However, investment is an exception to this rule, and it might seem counterintuitive to you at first, but paying more for financial services doesn't necessarily lead to better returns. In fact, it often leads to worse outcomes. Let me explain. Morningstar's Russell Kinnell has shown that a fund's annual fee is a strong predictor of future returns. And it's not just Kinnell. Many academics, fund companies, and also Jack Bogle have emphasized this as well. Here's what Jack Bogle has to say about costs.
I want to go back to something you mentioned a minute or two ago about the importance of fees and really looking at what you're paying for that return that's being created by corporate America or corporations around the world, and then the fee that is the one interruption for you to actually getting that return. Would you suggest then that somebody who's going through and evaluating a mutual fund to purchase, and there are sites and services like Morningstar and others that have all of the ratings and reviews and they tell you about the manager and all the rest, would you say that the best thing that someone could do would be to remove all of those factors and just rank them by fee and buy the ones that have the lowest fee? If you could do that without looking at anything else, obviously you'd end up with a number of Vanguard funds because your fees are average 0.12%. But is that a better methodology than the average person is using to pick a mutual fund?
Well, I'm tempted to say, and will say, ask Morningstar. They say that their sophisticated rating system works almost as well as simply rating the funds by cost.
Wow.
So they have entered the confessional booth. The problem is, in the financial business, value and cost are the reverse sides of the same coin. When you go into Costco or anything else you can think of, there's a value in your mind. You buy a Mercedes-Benz, you got a lot of value out of driving. Now, I don't know why anybody would get any great pleasure out of that, but maybe it's pride. Maybe they think Mercedes-Benz is a new star somewhere in the sky. I don't know. But you can't directly associate the cost with the value. Mm-hmm. But in the mutual fund business, it's how the returns are divided up between the marketplace and the investor. So this is a hard business to do it in without giving up your profits.
So back to the portfolio, because there is something what I've discovered. Because when we look at the cost of this client, he pays the following cost. So the ongoing costs are 0.73% for the fund management, and they are already factored in the return of the fund. But the management fee of 0.41% is not. So when we account for these costs, the fund performance drops to 0.31%, right? But there's more, because when I looked into the fine print of the fund, I discovered that the fund also charges a maximum of 3% to purchase this fund, plus transaction fees of 0.08%. And this brings the total cost in the first year to nearly 4.22%. And when you factor in these additional costs, the client's performance suddenly turns negative over those 3 years. So the question is, wouldn't it be better to invest in a low-cost ETF and don't try to beat the market and perhaps pay for a financial advisor to assist you? After all, 9 out of 10 fund managers do not outperform the market. And then there's the third part, the compounding effect. If you are aware of those costs, and recognize that this active fund manager is unlikely to outperform the benchmark, you might consider selecting and buying a simple ETF yourself, as I explained in this video. And you would agree with me that you could save a significant amount of money over time, right? Now let's calculate how much of a difference the compounding effect can make. Assuming the average return for a mixed portfolio has been 9.3% over all those years, we are being less optimistic with this calculation, assuming an average return of 6% over the next 30 years. If this client invests €100,000 with a 6% return, the final amount after 30 years will be €574,000. Now, if we subtract 1.57% from the 6% return, leaving a 4.43% return, the €100,000 would be worth €367,000 after 30 years. And this demonstrates how much this client could potentially save by choosing a lower cost investment option. As you can see, it can make a significant difference to review your portfolio's performance. So we have covered 3 important aspects, but there is a 4th one I haven't mentioned yet: asset allocation. The mix of bonds and stocks in your portfolio based on your risk tolerance and investment horizon can have a major impact on your overall returns. This client could have taken on more risk given his investment horizon and risk profile. And that's the reason why it's crucial to discuss your asset allocation with a professional, because there are substantial benefits to be gained. And that's why we have created this important video for you. Because many people believe that stocks are riskier than bonds, which is true in the short term, but not necessarily in the long run. In this video, we discuss long-term returns on stocks and bonds and show you that stocks may not be as risky as you think. So let me know in the comments below if you manage your investment yourself or if you outsource them. See you in the next video.